Hi there, Livewire readers and viewers. It's James Marley here, and welcome to our C-Suite reporting season coverage. I'm joined today by the Executive Chairman of Evolution Mining, Mr. Jake Klein, to talk about the company's results, but we're also going to talk about some of the big picture themes that are impacting the gold sector and copper. So Jake, thanks for coming in. Good to see you.
Thanks, James. Thanks for having me.
Well, let's start with the result. What were the key numbers that people need to get across?
I think the key number was the amount of operating cash flow that we're generating, $940 million, $840 million of EBITDA, and that was impacted by a very significant weather event. We were basically out of production since March at Ernest Henry, which is our biggest cash generator and most profitable mine. So our EBITDA margin it was 38%, it would have been 47%. So the message I want to give to investors is that gold can be a very high margin business, and 47% without that weather event is a high margin business.
Is the issue at Ernest Henry fully resolved now?
It is. So rain events, mine was flooded, the team responded amazingly well. We recovered at the end of June, we're back in production. The mine is operating really well. We just put out our fourth update to the mineral resource this morning. We've only owned this asset for 18 months, so we've been involved in it with an economic interest since 2016, but we acquired 100% of it from Glencore in 2021, so 18 months, December 2021. Unbelievable asset, world-class ore body. We've increased the copper and gold inventory by 50% over just 18 months.
Yeah. I did have a look over some of the key highlights from the report. You talked about those external events. You also talked about quite an intensive capital cycle.
Yeah.
Where are you at with that?
So we're just at the end. We think we've reached peak capital and we're going to go into a less capital intensive period, which means more cash generation, particularly in a higher gold and copper price environment. We're looking forward to more cash generation over the next 3 years.
Mm-hmm. And in terms of improving the margins, bring down cost, what are the things that are in your control?
Well, Cal, which is our big operation in New South Wales, we're introducing the underground mine, which is going to take the production up to 320,000 ounces. That's going into cash generation phase. Ernest Henry back to operational delivery. That's our high margin asset. Red Lake, the turnaround is progressing well now, and that margin should be improving. So, we want to get back to that 47 to 50% margin. Our costs are guided to 1,450 Australian dollars an ounce, really low cost gold production in FY24, and an increase in production by 16% to 770,000 ounces.
Mm-hmm, mm-hmm. And what about acquisition? I know you've been pretty busy. Is that something for a couple of years down the track? Any big plans? Is it just back to operational discipline for you now?
I think our organic growth opportunities are really good. We committed our one organic growth opportunity, which we committed to right at the moment, is the Mungari plant expansion that will increase production over there. Then we've got an Ernest Henry feasibility study. So we've improved the mine lives at our assets. We now have 3 of our 4 cornerstone assets with mine lives between 15 and 20 years, really long mine lives. Happy with that, happy with the organic growth opportunities, want to go into that lower capital intensity, cash generation. So never say never about opportunities, but we're only going to do things that improve the quality of our portfolio and that are accretive to shareholders.
Yeah. There was also a line around changing the maturity of the debt profile of the business. Talk me through what's happened.
So again, in line with that low capital intensity and just finishing a capital intensive phase with longer mine life assets, we decided to restructure the balance sheet. There are no debt repayments due in the next 12 months. We've now got our average debt out well beyond and matching the mine lives. We did US private placements, which are between 7 and 12-year debt placements. Average debt cost is around 4.6%. So really low cost debt. We funded all of the acquisition of Ernest Henry with debt. Didn't go back to shareholders. It's a very cash generative asset. In fact, is repaid all of the investment that we have made in that asset.
Yeah, yeah. Well, let's step back from the company result. I'm sure you're going to be fielding lots of questions throughout the day. You gave a really interesting presentation at Diggers and Dealers just recently, which I guess you outlined your bull case for gold.
Yeah.
The first question I have is, are you ever bearish on gold?
I have been. It's a cyclical business. When you think about the time when the US economy was going up and things are really progressing well. I think it was a time of macroeconomic stability. Globalization was the key thematic. Gold wasn't doing that well. I think here we're entering a phase of higher inflation. The Fed has been aggressive at trying to address that. But I think as soon as that pivots and they start to either stop raising rates or start reducing rates, I think you're going to see gold having its day again.
Okay. You talked about the 5 Ds, maybe too many for us to get through just now. But explain some of the factors that you think are specifically supporting the gold price.
Yeah, so I think there really are some very key catalysts for gold over the next 12 months. The first is rising debt levels. And you think about the US national debt. I couldn't believe it, but debt in the US was $40 billion after World War II. It's now risen to $32 trillion. That's almost $250,000 for every US taxpayer. The debt rises in the US by $100 million every hour. So until you can contain the debt levels, and the correlation between rising debt levels and the gold price is phenomenal. It's over the last 50 years has proven very correlated. So I don't think there's any stopping US debt levels going up. So I think that's a good indicator for gold. The other thing, James, we've known each other for a long time. You remember when I was involved in Sino Gold. This was a company that was involved in China. Globalization was the thematic. China and Australia were great friends. There was a free trade agreement signed in 2015. What's happened to that? I mean, now we have the Australian Defence Minister talking about preparing for war or getting on a war footing with China. And it's very adversarial. The US and its allies and the Western Bloc are adversarial towards other countries. And that decoupling is really having a very significant impact. I think I was really surprised that in 2017, $300 billion of capital was raised to invest in China. Today that number is $30 billion, so 90% reduction. And the third one I would say is destabilization. I mean, there's a major war going on in Ukraine. It seems to kind of be somewhat out of the headlines at the moment, but it is there. Russia and the Wagner Group are active in Africa and countries like that. And you're seeing the behavior of central banks reflecting this increased risk. So during the period of globalization, you had a reduction in central banks' gold holdings. Now, in this last decade, and particularly over the last 18 to 24 months, you've seen a very significant shift in central bank holdings, and they're increasing their holdings. So those three things, I think, are going to be real catalysts for the gold price. Yeah.
You mentioned that the sentiment towards gold in Kalgoorlie, which is the home of gold mining in Australia, was a bit soft. What do you put that down to?
Lithium stealing the limelight. It's critical minerals seems to be the headlines on every page in the newspaper. I try to remind people in the presentation that they shouldn't forget gold, because gold is the second largest metals commodity market. I did somewhat cheekily say that lithium and rare earths isn't even in the top 10. Yeah. But yeah, there are fortunes being made in the lithium space. There are some fantastic stories over there. But a lot of it is just stories. There's some fantastic companies emerging, but there are a lot of development opportunities that remind me a lot of a textile bubble that some are going to emerge fantastically, but some are going to not be of the quality that allows for development. Yeah. But everyone's excited about it right at the moment.
Yeah, understandably. One of the complaints I hear from investors locally is that there's no great way to get pure play exposure to copper, or there's limited ways to get exposure to copper, and despite the fact that they're quite constructive on the outlook for copper and want to get some exposure. Can copper play a bigger role in the strategy for Evolution?
Yeah, it can. So, I mean, our revenue base, you think about Ernest Henry, it's really a copper mine or a gold mine, or both. If you think about it in copper tons, it's about 55,000 tons a year of copper. It's now got a 17-year mine life. If you think about it in terms of gold equivalent ounces, about 300,000+ ounces of gold equivalent ounces. So yeah, it's our best asset. It generates significant cash returns. We like it, and we like the exposure to copper. We think that decarbonisation, which is one of those other Ds, is going to need $1.2 trillion, I think the World Bank has estimated, to get to that net zero target. And a lot of that is going to require copper as we decarbonise the economy. So there aren't discoveries of copper at the moment. We're incredibly fortunate to have Ernest Henry. It is a world-class ore body, and it's getting even better as we drill it. We'd love to own more copper assets, and particularly copper gold assets. But again, we always are looking at things through the lens of, is it actually accretive to our shareholders, rather than just doing it for the sake of trying to get exposure to a metal.
Yeah. Final question. We touched earlier on M&A, and you're sort of saying you feel like you've got a full plate, but never say never.
Yeah.
What about, more broadly in the gold sector, as a mid-tier gold producer, does Evolution become attractive to other global players at some stage?
We hope not, because the story of Evolution is not completed. I think there's a long way to go. I think there are interesting opportunities in a cyclical space like the gold sector, and I've always said this. You need to be counter-cyclical. We are always looking for the areas where the best value is. In the past, it's generally been from majors where we've acquired assets. They put themselves in great geological positions, but for one or another reason, the assets becomes non-core, and we've been able to pick them up and create a lot of value through discovery of additional ounces, extending mine life, expanding production. I think another area which is probably an area that is of growing focus and interest to me is the sort of emerging developer opportunities. Those companies are struggling because gold hasn't got that interest. So if they are short of capital, where do they get that capital? Their share prices are in the doldrums, and I think those are potentially opportunities for us, but only once we feel confident that we've established our operating platform, delivering to shareholder expectations. We've had a challenging 12 months in the past. We want to reset and go forward with that low capital intensity, high cash generation, and improved margins.
Okay. Well, thanks very much for coming in today. It's been great to reconnect and hear your story. And for all you viewers out there, I hope you enjoyed this C-suite interview, a great opportunity to hear directly from the people that are running the businesses on the ASX.